An investor with $3,000 might buy shares in 30 companies for diversification. This allocates exactly $100 per stock. But trade commissions create friction. At $10 per purchase, fees swallow $300, 10% of your capital, before any growth. Without more capital, solo investors often face dangerous weightings. Holding a 3 to 5% concentration in a single company means that if that specific business collapses, it takes a significant portion of your net worth with it. Retail investors are trapped by a mathematical paradox. They require the scale and diversity used by major institutions to mitigate risk, but the entry price for that level of efficiency is typically millions of dollars. The collective investment scheme is the mechanical fix for this barrier. By pooling the resources of thousands of individuals, the fund gains institutional scale. This allows it to absorb trade commissions so effectively that the cost to each individual investor becomes negligible. This pooling also dilutes individual risk. Instead of a high-stakes 5% weighting in one stock, the average holding inside a large fund drops to around 1.5%. One company's failure no longer threatens the stability of the entire portfolio. There are two primary drivers for these pools. Active managers use their own research to pick stocks they believe will beat the market. Passive managers simply use algorithms to track a specific index, providing the market's exact return at a lower cost. Operating this machine requires fuel in the form of fees. This technical definition of the ongoing charges figure, or OCF, is the most accurate measure of those costs. It covers everything from the manager's salary to the audit and custody fees required to keep the assets secure. While capital pooling removes the initial barriers of cost and risk, the investor swaps them for a structural obligation, the OCF, which is paid as a percentage of their total investment. The open-ended fund is defined by elasticity. As investors add or remove money, the fund creates or cancels units to match. The unit price is rigid, calculated daily based on net asset value, representing the precise market value of the underlying cash, bonds, and equities. However, this elasticity creates a vulnerability. If too many investors sell during a market panic, the manager may be forced to liquidate assets at a loss. To prevent a collapse, they can gate the fund, temporarily freezing all withdrawals. Contrast this with the closed-ended investment company. This is a rigid framework. A fixed number of shares are issued via an initial public offering, and that capital stays locked inside the fund. Because redemptions don't drain the fund's assets, managers can safely use gearing, borrowing money to buy more investments, to potentially amplify returns. Liquidity in a closed-ended fund works differently. Because it won't create or cancel shares for you, you must trade your holding directly with other investors on a live secondary market, like the New York Stock Exchange. This secondary trading creates a pricing quirk. Because the price is driven by supply and demand rather than a once-a-day calculation, the market price can disconnect from the actual value of the assets, meaning shares often trade at a premium or a discount to the NAV. The fundamental difference between these vehicles is the design of their containers. One is built to be elastic and respond to demand, while the other is a rigid structure built for market trading. To make strategic decisions, you have to look past a fund's marketing and examine its underlying mechanical framework. Open-ended funds are the tool of choice when you prioritize liquidity and the certainty of buying and selling directly at the asset's actual market value. You look to closed-ended funds when you want to exploit that rigid structure, either by hunting for shares trading at a discount or by utilizing gearing to increase your potential gains through borrowed capital. Stepping back, these vehicles allow the general public to access the complex machinery of the financial system. They turn the advantages of massive institutions into tools for the individual. By understanding these mechanics, everyday investors can scale the walls of high finance, wielding the purchasing power and professional access that were once the exclusive domain of the ultra-wealthy.